What's up, everybody? Welcome back to my channel. Today, we are going to discuss what is the difference between a tax credit versus a tax deduction. But before we get started, make sure you check us out online at jmc-accounting.net, where we do all of our blog postings. So every Monday, Wednesday, and Friday, we post a new blog, and you could also find some of our older articles. And then on Tuesdays, Thursdays, and Saturdays, we do a recap video of what we talked about the day before, and you can catch all the videos there. So don't hit the like and subscribe button on YouTube and follow us on Instagram. So let's get into it. What is the difference between a tax credit and a tax deduction? These terms are often thrown out there right around tax season or even through different postings on multiple social media outlets, but they sound very similar, but they're actually two totally different things for your taxes. And knowing the difference can help you save more money. So let's get right into it. What is a tax credit? A tax credit is like a gift card from the IRS. It takes money directly off of your tax bill dollar for dollar. So let's use an example here, right? Just to show you. Let's say that the amount of taxes that we came up with after we did our income and we took away our deductions is $1,000. Let me put my comma in there just so that we can see it, right? We have $1,000 in taxes that we are responsible for before any credits are applied. Now, let's say we have a tax credit uh, for $200. Whatever that tax credit may be, it's for $200. All right. So what that tax credit does is we take the taxes that we owe, we subtract any credits that we receive. In our situation, is $800, and now it reduces our total taxes owed that we're responsible for to $800. So that's what a tax credit does. It takes the amount of taxes that were owed and it reduces it from the credits dollar for dollar. Remember that, and lowers our total taxes that are still owed down. So let's get a little bit more. Let's dig a little deeper into what a tax credit is. So there's two different types of tax credits that you can receive. You can receive a non-refundable tax credit, which can lower your tax liability to zero, but not below zero. In other words, the taxes that you owed can't be less than the credit. So, for example, let's go back to our example up here. Let's say our taxes that we owe are $1,000, right? And let's say we have a non-refundable tax credit of $1,200, right? So, that means that this non-refundable tax credit can only lower our tax amount that we owe to zero. We can't go below that. We don't get the extra $200 and the difference between 1,000 and 1,200 because remember, this is non-refundable. It can only take our tax liability down to zero. Now, what are some of the common non-refundable tax credits? And we won't go too deep into them to keep this very simple and to keep this video on time. So some of the common non-refundable tax credits are child and dependent care credit, a saver's credit, which is usually for a retirement savings contribution, lifetime learner's credit for those getting anything that's post-baccalaureate degree, an adoption credit, a foreign tax credit, a residential energy efficiency property credit, which is usually for those that may have solar panel added to their house. You get a credit for that. And then you have the American Opportunity Credit, which is partially non-refundable. Only 40% of that is refundable. So let's get into the next one that I talked about, which is a refundable tax credit. What does this mean? A refundable tax credit can actually reduce your tax liability below zero. So unlike its cousin, non-refundable, this one can actually trigger a refund even if you owe no taxes. So let's use our same example. We say again, where you got $1,000 in taxes that we're responsible for. Let's say our refundable tax credit this time, our refundable tax credits is $1,200. This time, instead of bringing our total taxes to zero, with the refundable tax credits, it brings us to a refund of $200. Now, what are some of the more common refundable tax credits that we normally see out there when doing our tax returns? So you have your earned income tax credit, which is for those that earn under a certain amount. We have our child tax credit, which is partially refundable if you're taking, especially if you have the additional child tax credit. You have the American Opportunity Credit, and that's 40% refundable. Usually, you find that with those that are still getting their undergraduate degree, such as associates or some kind of baccalaureate degree. You have your premium tax credit for health insurances that are bought through the marketplace or AKA the Obamacare. And then you have your additional child tax credit, your health coverage tax credit, and some other qualifying family and sick leave tax credits that are refundable as well. So, just to do a quick recap, what is a tax credit? A tax credit is something, if we're looking at our example again, it is something that can simply lower the amount of taxes that we owe. So if we're looking at the taxes that we owe is 1,000, but we have credits of 800, that means that we now only owe in taxes $200. Now, what is a non-refundable? A non-refundable tax credit is is a credit that can't trigger us below our can't bring our tax liability below zero. So if we have $1,000 in taxes that we owe, and we have 1,200 in non-refundable tax credit, that means that brings our tax liability now down to zero. Now, let's say we have a refundable tax credit. So, just to review real quick, our taxes are 1,000, but this time we have a refundable tax credit of $1,200. That means that now the IRS owes us a refund of $1,200. Okay? So, now let's get into what is a tax deduction. So, a tax deduction is actually a direct reduction of the amount of income the IRS can tax you. So it lowers your taxable income, not your final bill. A tax credit lowers lowers your tax bill versus a tax deduction, which lowers the amount they can tax you on. So, for an example, let's say we're a W-2 wage employee, right? And our total income was $50,000 for the year. Now we have some deductions down here on line 12 that we're going to take. Let's take $2,000 for simplicity and deductions that we have that we want to take. So now with that, oh, I need an extra zero. With that $2,000, now we're going to take our income of 50,000 and subtract it from our deductions, and that brings our taxable income to $48,000. Okay, so that's what that does. A tax deduction reduces your taxable income, and your taxable income is what the tax table that the IRS looks at to tax you on. And then a tax credit reduces your tax bill. So when we're talking about credits, it's the taxes that we owe minus any credits, depending on the type of credit that we got, and it'll lower our tax bill or even trigger a refund. Okay, so let's go back up and talk a little bit more about the different common types of tax deductions that are out there that most people are may or may not be familiar with. So there's three different types of tax deductions that are the most common that we're going to talk about for simplicity in this video. One is the standard deduction, which is the most common. Second is an itemized deduction. And then number three is above the line deductions. Okay. So let's talk about the standard deduction, which is probably the most common that most people are taking. So a standard deduction is widely used by most people, and they don't even realize they're using it because of they don't simply qualify for the itemized deduction. Okay. So when you're taking a standard deduction, it tells you right on the 1040 what your standard deduction will be depending on your filing status. So if you're single or married filing separate, you're going to get $14,600 right off the bat. Married filing jointly and all that, as you can read here, depending on where you fall at with your filing status, you'll get different amounts. So let's say for simplicity issues, for our example, we're married, right? I mean, we're single. We're going to say we're single. So we're taking this 14,600 right on line 12, and that's our deduction right there. Okay. So what does this mean? It means that we're still making $50,000 as a W-2 wage employee. Now we're going to reduce our 50,000 by $14,600. So this brings our taxable income that the IRS is going to tax us on down to $35,400. Okay. So I know I threw out that term itemized deduction. What is an itemized deduction? And what is the difference between an itemized deduction versus the standard deduction? So the itemized deduction is if your total deductions that you have exceeds your standard deduction. So again, we're single. Our standard deduction is $14,600. But if we have a total itemized deduction of that exceeds that, we're going to use what we call a Schedule A. Okay. All right. So this is our Schedule A, and this is what we're going to use to summarize and to add up our total itemized deduction. So we're going to go through this kind of quickly. Okay. So, some of the most common deductions that you find in your itemized deduction are dental and medical expenses, taxes you paid. So I know you guys have probably heard, maybe in the news, maybe you haven't, is what we call the SALT tax, which is your state and local taxes. So that includes any kind of taxes that you pay for state income taxes. Yes, you can write that off. And sales tax if you live in a state where they have sales tax. Like Delaware doesn't have sales tax when you go shopping, so you won't qualify. But here in Pennsylvania, we have our state sales tax. Plus, if you live in the city of Philadelphia, you pay an additional 2%. So you can actually write your sales tax off anytime you shop at McDonald's, the mall, anywhere where sales taxes are applied. And then also it takes off for your property taxes. Based on the different boxes. So that's taxes paid is another area for your itemized deduction. And then we have interest paid. So for our interest paid, that is usually something that is for your mortgage on a home and your points that you paid throughout the year for your mortgage. Okay. And then we have our gifts to charity, which I know is a big one. A lot of people say, "Oh, I donated." But if you don't donate amount of, in our case, for being single, that's more than our standard deduction, then you're going to take the standard deduction. I think that's where a lot of people get confused. They have their charity, they give the charity, or they paid interest on their mortgage on their home. They pay certain sales tax, and they had certain medical and dental expenses. If all of this stuff added up together does not meet or exceed the standard deduction, you're gonna automatically go into the standard deduction because you're gonna be paying more in taxes if you don't. Okay, and we'll get into that once we finish reviewing here. Okay, so that's what your itemized deductions are. They are pretty much anything that you did throughout the year that exceeds that standard deduction. So if we go back to our 1040, right? And for an example, we're still a $50,000 wage earner, right? And this time, and we're still single, but now we took our Schedule A and we added up all of our itemized deductions, and it actually came out to $30,000. Okay. So what does that mean? That means now that our taxable income is now only $20,000. So what does that mean? That means that since we're in the lower tax, since our taxable income is lower, we are now being taxed at a lower rate because of our itemized deductions versus if we took the standard deduction of 14,600, we're now being taxed at a little bit maybe higher depending on the tax brackets. We're being taxed at a higher tax bracket of 35,400 that the IRS is going to recognize. So that's why this standard versus itemized deduction is very important. It can help, like I said, to help you save on taxes just by simply knowing the difference between your standard or your itemized tax deduction, because it can really help with lowering your taxable income, which means that you're going to be in a lower tax bracket, which means you're paying less in taxes. Now, there's one more one we got to talk about before we get out of here, which is our above the line deductions. So, what is our above the line deductions? Our above the line deductions are those adjustments before line number, what is this, line 11, which is our AGI, our adjusted gross income. So there are going to be line items that hit line 10, which is our adjustments to income. And some of these above the line deductions that are most common are student loan interest, our educator's expense up to $300 per teacher, or $600 if you're married, filing joint, and both spouses have to be educators. You have your traditional IRA contribution, which is a above the line deduction. You have your health savings accounts contributions. If you're self-employed or you have your a side hustle or any kind of gig, your self-employment tax deduction, which is 50% of self-employment tax. And then you have your self-employed health insurance premiums and alimony for those who were divorced before 2019. So alimony paid before 2019, you can still take an above the line deduction. So what does that mean? So for simplicity issues, we'll say student loan interest, as that seems to be a more common one that I find within my practice. So let's say your student loan interest